Hey guys, it's Tortoise Investing. I just want to give you some examples today of compounding and letting time work for you in the long run. So we are on the drip returns calculator. You can Google this, and I'll have a link to it actually in the description down below as well. You can fool around with this with some different timetables and things like that. But what this is going to show you is your annual returns if you just let time work for you. You just set it and forget it, which I feel is the ultimate way of investing. I have now went all ETF, and I am just DCAing through. If I open up my phone, oh look at that, big old red day, buy some ETFs. It's kind of how I'm doing things, and I'm going to do this for a couple of years, see how things go, and I think it's going to go well personally. But we take a look here. If you would have invested $10,000 into the S&P 500 back in 2010, your annual return would be 12.65%. So a little bit over $50,000. Not too bad. But if you would reinvest those dividends, this is where it shines. $57,000. Your annual return's 13.74%. So you're gaining over an additional percent in annual returns. And that's going to stack each time you get a payment. And you can use that to buy more as you're DCAing to buy more. And it just rolls into itself. It gets bigger and bigger and bigger and bigger over time. But DCAing in, having a great mindset of a long-term view on things, and just letting stocks work for you, don't work for the stock. But yeah, this is just one example. If you'd have put $10,000 in, let's say you were the luckiest person in the world, and back in 2004, you were like, you know what? I believe in Apple. I think Apple is going to do great things going forward. In 2004, you'd put $10,000 in January 1st. Well, congratulations, you're a millionaire. And this is another prime example of, even though it's got a small dividend, when you compound it, just how much more you can get in the long run. So this is over a 20-year period. $10,000 in the Apple in 2004 would be worth $4.775 million today. But if you would have reinvested those dividends, right at 5.39 million. I don't know about you, but if over a 20-year period I can make an additional, what is that, like $700,000 just by dripping with an initial investment of 10 grand. I'm not going to say that you're going to go out there and find the next Apple. This is just an example of just how strong the compounding effect is. Let's choose a big dividend payer. Let's choose MO here, Altria. I apologize for my voice. So, if you would have put $10,000 in the Ultra in January of 2004, 20 years ago, your ending investment would be $30,930. You'd be like, well, that's not that much. 20-year period, I've only averaged 5.71% on my return. Well, if you would have dripped, you would have an annual return average of 12.62%. You're beating the SPY. You are beating the S&P 500 with Altria because of drip. Look at this. You don't drip, S&P 500 just wrecks you. 8.53% average over a 20-year period. If you do drip, it's a different story altogether. You beat the S&P 500 all the way through here, and you end up getting a 12.62% return over a 20-year period. A couple more examples here. Let's say stock ticker. Oh, Realty Income, the monthly paying dividend company. Go ahead and hit the magic button. Over 20-year period, again, we're not beating S&P 500. We're not beating the SPY. You got 8.23% return average. The S&P 500 is 8.53. With the dividends, over 10% over a 20-year period at 10.74%. S&P 500 is 9.76%. Your initial $10,000 into Realty Income is now $79,500. This is just a couple examples. I can sit here and do this all day long, and just proof in itself that let time work for you. Let your stocks work for you. Don't work for your stocks. If you're stressing out and you're like, oh God, earnings is coming up, I'm scared, maybe you need to reevaluate. Not financial advice. I'm not going out there and telling you what to do. Just, I changed my mindset. Again, I went full ETF because I was like, you know what? I'm looking at a retirement horizon 15, 16 years from now. And I still want to do this YouTube thing. I want to research stuff still. But with my money, I want to be as secure as possible. Still market beating. But my portfolio setup, I feel, is very good. 33% is in VYM. 16.5% is in VUG. It's Vanguard Growth. 16.5% is in the Vanguard Technology, I think VGT. 17% is in VTI, it's the Total Market Index. And the other 17% is in VOO, the S&P 500. And that's what I've been rocking last couple weeks. That's what I'm going to be doing going forward. Checking my phone a lot less often. I'm not worried, oh God, I had an earnings, am I going to drop 10, 20%? Of course, if that happens, you invest in individual stocks. It's prime buying opportunities, but like, it's a mindset thing for me. And I looked at the picture over a longer period, and this is what I've came up with. And I think it's going to work out. I think I'm going to be able to look back 15, 16 years from now and be like, man, that was a smart idea right there. But we'll see. Join me on this investing journey. Hit that subscribe button. Hit that like button. I greatly appreciate it. Let me know down below. Do you own any ETFs? Do you do any drip? I'd love to hear from yous. But yeah, it's everything I got. Until next time, take care. See yous.